Hi everyone, welcome back to Annie Unleashed. Today is video 3 in the 10-part series on TFSAs. Today we're going to talk about how the earnings on your investments in a TFSA account get taxed and how it could affect your government benefits and credits. I'm going to walk through an example that's provided on the CRA website. Before I jump in, I just wanted to let you know about this free downloadable PDF guide that I created called Investment Flow Guide. And it's the 4 general investment types that I've seen over the 20 plus years that I've been in financial services. It's fun. There's some really practical do's and don'ts, some tips, and even platforms and tools that would be best for you depending on how you need to invest. It's in the link in my description box. Go and check that out. Let's get started on TFSA earnings. The secret to making your money work smart partly is knowing how taxes work. Although taxes can sometimes sound like a really overwhelming topic, I'm going to just break down some really basic, simple things for you to understand how knowing how taxation and your investments can work for you so there's more money in your pocket and you don't have to work so hard. TFSA accounts as an investment account is one of the great types of investment accounts that can really help your money grow smart without being taxed so much. A couple things you need to know about how different investment earnings are taxed. Now, interest income, like you might get in your savings account, is 100% taxed, meaning that any interest you earn on your savings account is taxed every year. 100% taxable, which means whatever your marginal tax rate is, and that depends on what your income is, that's how much your interest income will be taxed. Now, dividend income is what you'll get in with certain investments, not in a bank account, not in a savings account. It has to be an investment account. That has a more preferential treatment in terms of taxes, less than interest income. And then you've got capital gains. Gains income is basically the money that you bought it for, the money that you sold it for, hopefully way more than what you bought it for. And that difference is called capital gain. That capital gain, 50% of that is taxed based on your marginal tax rate. So those are some basic foundations of knowledge around how different investment income is taxed. Now, this is going to be really important because, as I've mentioned, savings accounts, like in your bank savings accounts, earns interest only and it's 100% taxable. But if you had interest income in a tax sheltered investment account like a TFSA, you could still earn the interest income and it wouldn't be taxed at all, which is really key. That means that there's more money in your pocket and the money stays in the account and more money grows more money. We call that compounding. The effect of compounding means that you could, in essence, double your money every 7 to 8 years, depending on your interest rate and so on. The foundations are really important because when you have a bank account, a savings account, or a cash investment account, any income that you earn on your investments is fully taxable. The interest income, capital gains, and dividend income, you can have all of those types of investment income in a TFSA account and none of it is taxable, meaning you don't pay any tax on that investment income. You don't have to pay the government. It stays in that investment account or it's there for your use. And the more money that's in your account, faster it grows on itself. That's a really, really key foundational piece here. When it comes to how the investment income affects your government credits and benefits, we really need to look at the benefits and the credits provided by the federal government that are income tested, meaning that the amount that you get from the government benefits and credits depends on how much you're making. When you're trying to figure out how much do I qualify for in some of these government benefits and credits, you have to take a look at what the criteria is based on how much you're making in the previous year. When it comes to TFSAs, because you don't claim any of the investment income earned in your TFSA investment accounts, that means that it doesn't get counted as income for the government benefits and credits. That's really key. It's another really great benefit of having a TFSA account. Let's walk through some of the government benefits first, and then I'll talk about some government credits. Some of the government benefits that are usually affected by income earned, including investment income earned in your cash account, your savings account, and so on, are EI, in other words, employment insurance, which, by the way, side note, until October 11th, 2025, there is no waiting period on your employment insurance benefits. So if you need to claim on your employment insurance, and I know lots of people who have here and there, I certainly have in the past, but this year, because of the economic situation, they've decided to waive the waiting period until October 11th, 2025, so this year. If that applies to you, go and check it out. Now, one thing I want to really express is that government benefits doesn't necessarily mean for retirement only. Employment insurance benefits apply in all sorts of situations and usually before retirement. So whether you lost your job, maybe you're on parental leave, or you're taking care of a sick family member, all of those situations can apply. You can be on employment insurance and get those federal benefits in those different situations, and usually that's way before retirement. Now, employment insurance is impacted by income, therefore it's income tested, but TFSA earnings are not taxed, therefore don't count as income, and therefore don't affect your employment insurance benefits. Now, the two other government benefits that are usually income impacted are old age security, which is usually in retirement, and guaranteed income supplement, also in retirement. Neither of those are affected by your earnings in your TFSA investment account, which is great news. Now let's go to government credits. There are 4 types of government credits that I'm going to mention that are usually income tested, but because TFSA doesn't have investment income that is taxed, they don't get affected by TFSA investment earnings. Canada Child Benefit is one of the federal credits that is granted to parents who have young kids. It is definitely adjusted for income, and an investment income that is taxed does get counted as income, but not with the TFSA. So your TFSA does not affect your Canada Child Benefit. The second one is the Canada Workers Benefit, also usually income tested, but because TFSA earnings don't count as income, it doesn't affect Canada Workers Benefit. So you can still get what you need to get, plus your TFSA earnings are always there and available for you and not taxable. The last two are your GST or HST, depending on your province. Those are also not affected by TFSA investment earnings. And the last one is the age amount, also usually income tested, but because TFSA earnings are not taxed, doesn't affect the age amount credit. Now, I'm going to walk through an example that's provided on the CRA website, and I'm going to put my financial planner hat on because the example that's provided is pretty simplified. So I'm going to point out some things that I would normally point out when I'm teaching this in a college class to my financial planning students or to my clients that I'm helping out. So I want you to look at some things in a bit of a different way. There is a reason why it's simplified, is just focusing on how TFSA investment income would affect your overall income and how that gets taxed. But I also want to point out some things that I notice as a financial planner that's kind of missing from that example. Okay, so I have here on my laptop screen the CRA, Canada Revenue Agency website, specifically for the tax-free savings account. I will attach this link in the description box, as well as a couple worksheets and a couple other things that you'll find helpful. I'm just going to go through this page, but specifically go through the example of how TFSA investment earnings are taxed, aka not taxed, and how it can affect you compared to investment earnings that are earned outside of a TFSA account. So let's jump in. So as you can see here, I'm on the Canada Revenue Agency website for tax-free savings account, the guide for individuals. And as we scroll down, we're going to have a table of contents. And the one that you want to go through is called the impact on your government benefits and credits. Here it runs through some of the benefits and credits that I've mentioned that are not affected by the TFSA earnings. And these are benefits and credits that are impacted by your income, any income that you need to claim and therefore are taxed on. Now, in this example, Dennis is retired. Now, we don't know what age he's retired at, and this does make a difference for a financial planner. That's why it's really dependent on your individual situation. But for the purpose of simplifying this example, it just says Dennis is retired. In addition to his pension, which is great. A lot of people aren't receiving pensions anymore, but some people still are. In addition to his pension, he receives old age security and Canada Pension Plan. He earns $500 a year in interest income from his TFSA savings. Now, remember, if it wasn't for a TFSA, if he earned $500 a year in interest income, it would be 100% taxable based on his marginal tax rate, meaning all of that income qualifies to be taxed. Now, let's continue reading. Neither this income nor any TFSA withdrawal will affect any federal income tested benefits or credits he receives, as they do not have to be included on his income tax and benefit return. If he had earned $500 in a regular savings account instead, it would have to be included on his income tax and benefit return, and he would have to pay more tax and could have to repay some of his social benefits. Now, that's a key thing. As a financial planner, when we are looking to help people plan for retirement, we're not looking to help you plan like the year before. We actually look at your retirement income, your retirement plan, your retirement government benefits, especially the ones that are income tested, about 10 to 15 years before retirement, if we have that relationship with you already. So a good financial planner will look at your retirement 10 to 15 years in advance of your retirement age, whatever that age is for you. Let's look at the breakdown here of the numbers. The impact on your income tested benefits. So here we have Dennis. Let's assume that he is age 65. He's in retirement age, which is why he qualifies to receive old age security and Canada Pension Plan. Here we've got his total pension income of $48,000. Now you'll see the two columns on the right. We have funds in a TFSA investment account, and on the right, funds outside of a TFSA investment account. Because if you have watched my previous two videos on TFSAs, the first one was the 5 basics to know about TFSAs, and the second one was about contribution limits. You'll know that you can open up and have a TFSA at any age. There's no age limit. And it works the same. It doesn't change how it works based on your age. It's the same at any age. So in the first and second column, you'll see that the pension income amounts are the same. CPP and OAS benefits are the same. Dennis earned $500 of interest income. If it was outside of a TFSA account, he would have to report it. What you can see here that really counts is his interest income, because it's earned outside of a TFSA investment account, has to be claimed as income. So it is listed here. But if he had earned the $500 in his TFSA investment account, even if he had earned that, it does not have to be reported as income for that year. So you'll see that the total income, there's a difference of the $500, and that's before tax. What you'll notice is there's a line called the amount over the base amount. And what that's really referring to is the difference in the total income versus what they provided as an example for the fictitious base amount for social benefit repayments. For the example where the interest income was earned, there's no difference in the example where interest income was earned in a TFSA account, but there is a difference of $450 in the example where interest income is earned outside of a TFSA account and therefore fully taxable. Now, what they've determined here, the reason why you see the line multiplied by 15% is because up until about $57,000 or so, the federal tax rate is 15%. Now, this obviously is not the entire situation. You're going to have to consider your province and therefore the provincial tax rate and so on. So it's not a complete specific picture, but because it's talking about federal benefits and credits, it's referring to the federal tax rate in this example. These are really specific and important things to know, and this is what financial planners look at and really highly skilled advisors who do a lot of tax planning. So in the end, the key number here is that the last line, if you look at that, it says amount to be included as a social benefit repayment. If you had income, investment income outside of a TFSA account, you would have money that would then go against your federal benefits and credits. Here they refer to it as the social benefit repayment, meaning that you would have to pay back some of the government benefits that you're getting. Maybe if it's old age security, for example, it has to be paid back when you do your taxes. Now, this doesn't seem like much in this example. It's only $67.50. However, what's really important here is that this is just like a really isolated one-off situation. By the time you get to retirement, most people have earned significant money in their investment accounts, meaning like hundreds of thousands of dollars. Those hundreds of thousands of dollars earn pretty good investment income. Let's call it thousands of dollars of investment income every year. So if we're looking at this example of $500 and the repayment is $67.50, imagine this multiplied by like 10, 15, 20, like it can get pretty hefty and impact your federal benefits significantly. So this is why it's really important to understand how investment earnings are taxed depending on your investment account, whether it's a TFSA, RSP, a cash account, or even the interest income in your savings account, which is eaten away by inflation and by taxation. And how it's really important to get specific advice based on you and your situation, and get that advice in advance of when you're gonna want to use those federal benefits and credits. I hope you found this video helpful. It got into some technicalities. I tried to keep it really high level. Now you know that when it comes to TFSA investment earnings, they are not taxed, and therefore it's one of the key benefits of a TFSA because it doesn't affect any government benefits like employment insurance, old age security, or guaranteed income supplement whenever you are claiming them and receiving them from the government. And it doesn't affect your government credits that you can receive at any time before or after retirement. Now, in the next video, I'm going to talk about withdrawals from a TFSA. And that's really important too. You want to know how to do that smart and the tax efficiency around it. And again, we're just talking about TFSAs, but when you're looking at your whole picture, you really want some specialized advice from a financial planner like myself, or an advisor who really focuses on making your money work smarter for you so that you don't have to work harder. Just before we go, I have created that free downloadable investment flow guide. It's based on my 20 plus years experience in the industry and some of the 4 key profiles that I've seen. It breaks it down as to what your profile may be, some do's and don'ts based on your profile, some bonus tips, and platforms and tools that you may find helpful based on how you need to invest. Because believe it or not, not everybody has to do it the same way. Everybody has their own way of doing it, but ultimately, the result that we're looking for is that our money makes more money on itself in a smart, tax efficient way. So hope you've enjoyed this video. I'll see you in the next one where we talk about how TFSA withdrawals work and how it affects your tax situation and how to make it really work smart for you. Feel free to share some comments in the video. I do respond to them all. And if there's any questions that you have that you want to learn more about how to make your money work smarter for you, especially when it comes to investment accounts, pop that in the comments too, and I will definitely consider it as a future video. Have a wonderful day. I'll see you in the next one.